Oak Ridge Leasing Corporation signs an agreement on January 1st, 2020 to lease equipment to LeBlanc Limited. Oak Ridge and LeBlanc follow ASPE. The following information relates to the agreement. The term of the non-cancelable lease is 5 years with no renewal option. The equipment has an estimated economic life of 6 years. The asset's fair value at January 1st, 2020 is $80,000. The asset will revert to the lessor at the end of the lease term, at which time the asset is expected to have a residual value of $7,000, which is not guaranteed. LeBlanc Limited assumes direct responsibility for all executory costs, which include the following amounts: $900 to Rocky Mountain Insurance for insurance and $1,600 to James Township for property taxes. The agreement requires equal annual rental payments of $18,143 to Oak Ridge, the lessor. Beginning on January 1st, 2020, the lessee's incremental borrowing rate is 11%. The lessor's implicit rate is 10% and is known to the lessee. LeBlanc Limited uses the straight line depreciation method for all equipment and rounds amounts to the nearest dollar. LeBlanc uses reversing entries when appropriate. Answer the following. Calculate the present value of the minimum lease payments for the lease in any way we want. And then prepare an amortization schedule, prepare the journal entries, etc. Okay. So first we need to know if this is a capital lease or not. So let's go through the ASPE criteria. So ASPE criteria for a capital lease have to meet 1. Okay, so the first one is the transfer of ownership. So are there any reasons that this equipment will revert to the lessee at the end of the lease? It says that somewhere it said that the equipment will revert to the lessor. The equipment asset will revert to the lessor. Okay, so this is a no. 2, we've got the economic life test. So greater than 70% is the lease greater than 75% of the economic life of the asset. So this lease is going to be 5 years, and let's see. What's the economic life? The equipment has an economic life of 6 years and the lease is 5 years. So we're going to have 5 equals 5 divided by 6. So we're going to get 83%. So yes, this is met. So we know it's a capital lease. And let's just check the last. So the present value of the minimum lease payments are greater than 90% of the asset's fair market value. And we're asked to calculate the present value of the lease payments anywho in part A. So let's do that. So calculating the present value. So we're going to have N, which is going to be, I think, 8 years, if I remember correctly. No, the lease is 5 years, sorry, 5. Then we're going to have the interest rate. So what interest rate are we going to use? Now, remember that we're under ASPE here. So we've got 2 interest rates. We've got the incremental borrowing rate at 11 and the lessor's implicit rate at 10. So which rate should we use? ASPE requires us to use the lower of the 2 rates. So we're going to use the implicit rate of 10%. So our I is going to be 10. Our payment is going to be a cash outflow, so we're going to make it negative. And what are the payments here? $18,143 for that question. And the future value is 0 because up here it says that the asset's expected to have a residual value of $7,000 in 3, which is not guaranteed. Okay, so one of the questions that I have is these lease payments of $18,143, are there any executory costs included in there? Because we need to be really careful to make sure that there's no executory costs in our lease payment. So it says here that the lessee, where does it say? the LeBlanc, so who's LeBlanc? Oak Ridge signs an agreement to lease equipment to LeBlanc. So LeBlanc is the lessor, and it says LeBlanc Limited assumes direct responsibility for all executory costs, which include the following annual amounts. But I suppose these amounts are not, well, they assume direct responsibility. So what that means is that they cut checks directly to these two parties. They're not included in the lease payments. So otherwise it would be that LeBlanc pays Oak Ridge for those executory costs and then they pay them, in which case it would be included in the lease payments. But because of the way that this is worded, that they have direct responsibility and they pay these amounts, means that there's nothing we need to take out of the lease payment. So using this $18,143 is okay. So remember to make sure that we have begin mode on and our compute our present value. We are going to get $75,654 as our present value. Okay. So we've calculated the present value, which was the first one. Next, we're asked to prepare an amortization schedule. Amortization schedule. So we're going to have the dates down the side. So 1/1/20. Is that 1/1/20? Let's see. Yeah, January 1st, 2020. And we're going to have that date twice. Then we're going to have 1/1/2021. Oh, 2024 is when the lease ends, actually. Okay, so now we've got all of our years here. So we've got a 5-year lease, so we've got 5 years as our count, which is correct. Okay, so what we're going to do here is we're going to put, let's actually label our columns. So we're going to have lease payment, interest expense. We're going to have reduction of lease obligation. Okay, let's make this a bit bigger. Okay. Reduction of lease obligation, and then here we're going to have the carrying value. Okay, the carrying value of the lease obligation. So here, the first thing we're going to do is put the carrying value of our payment, the present value of our minimum lease payments. Then we're going to say, okay, our lease payment each period is $18,143, which is going to be the same each period. Our interest expense is going to be at the market rate. So our rate here was 10%. Remember the lower of the two rates times the carrying value. Actually, no, first, this is really important. I've made this mistake before, but I hope that it's helping you. So the first date, the interest is 0 because remember, these are annuity dues. So this is actually January 1st. There's no interest accrued. So we need to remember, I would suggest highlighting this cell or doing something to flag it because I've made this mistake. The first period interest expense is going to be 0. So the reduction of the lease obligation is simply going to be exactly this. Normally it would be the difference between the two, that the lease payment minus 0. So the carrying value is going to be this minus this, meaning that our carrying value on day 1 is $57,511. And when we do the journal entry on inception of the lease, we're going to have this exact amount come out because we're going to have debit, right of use, or actually this is ASPE. So we're going to have equipment under lease. So we're going to have this amount as the present value. Then we're going to have credit cash, which is going to be our lease payment, which is always this amount. And then we're going to have credit lease liability, and it's the balancing figure between the present value of the lease payments and the first lease payment. So we're going to have $575.11, which is exactly what we get right here. Okay, so that is why we need to end up at this amount. This was the same as the right of use asset. This is the full minimum present value of our minimum lease payments. The interest expense in the first year is 0 because this is on day 1. Now going forward, we'll have an interest expense. It's going to be the carrying value times the interest rate that we're using. So I can pull all these amounts down. So this is 10%, carrying value times 10%. This is the difference between the lease payment and the interest expense, right? And then this is our carrying value, which is taking the carrying value minus the reduction each period. And we want the lease to be on our balance sheet at 0 when the lease ends. So we need to take 20 cents off here. Oops. Fix that. 0.20. What happened there? Maybe it's plus 20. Sometimes you need to make some minor rounding differences here, and let's get rid of that. Should round out. Okay, so there we go. And so if we sum these up, let's just see what our total obligations would be under the lease. And this is our total. This is statement of financial position, so we shouldn't have a total here. Okay, and so this is simply showing what our total amounts are here. Okay, so you can see our total reduction is equal to this, ending up with a carrying value of 0 when the lease matures. And normally we wouldn't have, there we go. Okay, so let's see what else we need to do. C says prepare all of LeBlanc's journal entries for 2020 and 2021 to record the lease agreement, the lease payments, and all expenses related to the lease. Okay, so we've got, this is the entry on the inception of the lease, so we've already got that one for 2020. So now we're just gonna have our year-end 2020 entries. Sorry. So our first entry is going to be interest expense on the lease liability. So we're simply going to have debit interest expense, credit lease liability. Okay, so forgive my spelling there. So our interest expense is going to be the end of 2021. Our interest expense is going to be this amount. And this amount. Actually, this amount here should have been called obligation under capital lease because we are using ASPE. That's IFRS terminology, so forgive me for that. Obligation under capital lease. So we've got equipment under lease, cash, and obligation under lease. This can actually just be called obligation under lease. Okay. Whoops, what happened there? Something crazy. Okay, obligation under lease. Okay, so then here we've got debit interest expense, credit obligation under capital lease, obligation under lease. Okay, and we're going to have this this amount here of 5751. Okay, now the one thing we did miss here, just going back, so this is January 1st, 2020. So we recognize the correct entry on inception of the lease, but don't forget about these executory costs. So we need to recognize those as well, executory costs. So we're going to have debit insurance expense, debit property tax expense, and credit cash. Or, so this is going to be 900, this is going to be 1600, and our cash is simply going to be some of these items. Okay, so that was our executory costs. Now we've got our year-end entries, we've got our interest expense on the lease obligation, and then next we've got our depreciation expense on the equipment under lease. So we're going to have our equipment under lease is going to be this amount. Now this is a 5-year lease, so it's straight line depreciation. So it's going to be this divided by 5 years is going to give us an annual expense of $15,130. So we're going to have debit depreciation expense and credit accumulated depreciation. Equipment under lease. Equipment under lease, okay? And so this is going to be this amount, 15,131 rounded. Okay, perfect. So we got all those entries done. Now our next entry, so those are all of our year-end entries. Now let's look at what we need to do for January 1st, 2022 journal entries. So we're going to have our lease payment, which is going to be debit. Which is going to be debit lease, which is going to be debit or lease payment. Obligation under lease. So we're going to have, okay, so debit obligation under lease. Which is going to be 12,000. So our total lease payment we know is going to be credit cash of 18,143. Whoops. Here, let me fix that. So let's go up to our schedule here. Okay. And our obligation under lease is going to be 18,143 credit. And here our obligation under lease is going to decrease by $18,143. And then we are going to have the executory costs. And these are actually going to be exactly the same. This entry will be no different. It's exactly the same entry. Okay, so now we've got our executory cost entry. And then we're going to have our December 31st, 2022 entries, which is going to be interest expense on the obligation under lease, which is going to be debit interest expense, credit lease liability. And this is going to be right from our schedule. So December 31st, 2022, which is essentially the same here. So I think this is going to be 3,149. December here. December 31st, 2022. Is that the right period? 2020, this is 2021, sorry. Okay, so this is also 2021. Too many videos. 2021. Okay, so here's our interest expense, and this is going to be this amount. Yes, it is. And then we're also going to have our depreciation expense, debit depreciation expense. Spelling is getting really bad too. Is going to be this amount because it's straight line. And then this is going to be credit accumulated depreciation equipment under lease, and it's going to be the same amount, 15,132, 131. And that finishes off this one. Okay, let's see what we have next. Show that Oak Ridge, the lessor, used to arrive at the lease payment amount of 18,143. Okay, so how did the lessor compute the lease payments? Okay, so I don't know why that happened. Okay, so what we're going to have then is we need to figure out the rate of return from the lessor. So the fair value of the equipment, fair value of the asset leased, is given in the question. So the fair value of the asset leased is going to be, where is it? The asset's fair value at January 1st, 2020 is $80,000. So the fair value, so this is really computing the rate of return for the lessor. In some ways, it's taking the rate of return and then calculating out the lease payments. So the present value of the unguaranteed residual value, unguaranteed residual value. So we're going to need to calculate this as the present value of the $7,000 in 5 years. And then that will give us the amount to be recovered. Through lease payments, because that's what the lessor is actually out. And so it's going to be this minus that present value, which we haven't calculated yet. And then we're going to say five lease payments. Which is basically taking that amount and calculating it as the present value of an annuity due. For 5 periods at 10%. Okay, so what's the present value of $7,000 in 5 years? So let's start with this. Present value of the unguaranteed residual. So it's going to be, N is going to be 5, I is going to be 10. N is going to be 5, I is going to be 10. The future value is going to equal 7,000. And the present value is compute present value. So let's give that a go. So we want to take the begin function off here, I believe. Okay, so let me give this a go. So we're going to have N5 I, oops, N5N, 10I, $7,000 future value. Compute present value. Okay, so the present value of this is going to be 43,000. 43,046. 45. Okay, so that gives us this number. So that means we need to recover $75,654. And what this is going to do is say, well, so then we need to calculate, this is going to be the present value of an annuity due for 5 periods. So what's that going to be? So over here, we're going to have the same inputs. N is going to be 5. Oops. N is going to be 5. I is going to be 10%. The future value is going to be 0. And the present value is going to be to be recovered. Is going to be, I wonder if this needs to be the future value. 75,654. No. see. So we want the begin function back on. So we're going to go 5N 10I to be recovered through lease payments. Okay, so where we got to here is we said, we know that for the lessor said the fair value of the asset that they're leasing is $80,000. They expect it to have a residual value at the end of the 5-year lease of $4,300, which is not guaranteed, but they still expect to recover this amount. So they could potentially sell it for that at the end. And so that means the amount to be recovered through lease payments is the less of the two. So they only need to recover this value because they expect the lease of equipment to be worth this at the end. So how do we know then? So this is what they need to recover. And we had to calculate out the present value of this guarantee, of the unguaranteed residual value, which we don't include in our lessee present value of lease payments, but the lessor does include in the calculation of what they need to earn a return on, because this is part of their return. They can still make money on this value that the equipment has at the end of the 5 years. So we calculated what the present value was, because in 5 years, we can't say that $7,000 isn't the same today as it is in 5 years. So we calculated the present value of the $7,000 in 5 years right here. Okay, so this is the present value of the unguaranteed residual, and it gave us a present value of $4,300, which is what we took off to figure out what the lessor needed to earn a return on, or what they needed to earn back through lease payments. Now the question is, what should the lease payments be? So it's not as easy as taking this number and dividing it by 5 years, because we also need to take into account the time value of money. So we need to put our begin function on. So here is no begin function, because here we are looking at the end of the period, what do they need to recover? But here we do need our begin function, because now we're back into computing lease payments. And here we're going to say, okay, so to figure out our lease payments, it's a 5-year lease. The interest rate's 10%. The present value of the leased asset is going to be negative $80,000, an outflow. And the future value needs to be 7,000 as our input. So compute payment, and we'll get 18,143, which are the exact lease payments that we've agreed to. So this proves that the lessor will earn a return of 10%. Okay, now what? So we finished off that. D. Now E says provide the required note disclosure for LeBlanc Limited concerning the lease for the fiscal year ended December 31st, 2021. So note disclosure, year end December 31st, 2021. Okay, so what we're going to say is the following is a schedule of future minimum lease payments under the capital lease expiring December 31st, 2024, together with the balance of the capital of the obligation under a capital lease. So then we're going to have year ending December 31st as our header. And we're going to have the years of the lease. So remember, this is 2021. So the next year is 2022, 2023, and 2024, which is when the lease expires. Now, what are our commitments under these leases? Well, if you look back up to our schedule, we know that every year we need to pay out this $18,143 payment. So this is the amount that we're going to pay out right here. Okay, so we've got these three amounts. So these are the periods that we're looking at here. So 2022 is going to be this. Let's do something with that to make sure we know what we're doing. Okay, now it's also, we also need to know the interest expense. Well, let's just finish with this schedule first. So here, this is going to be our total minimum lease payments. Okay, and so this is simply going to be the sum of above. Okay, so that's our total minimum lease payments. Okay, now we're going to have less the amount representing, because remember, the lease payment that we're making is a combination of principal and interest. Interest at 10%, and we use 10% because that's our interest rate. And here what we're going to do is, you can see in our schedule how we took these 3 periods. Now we're taking the same 3 periods for the interest expense total from our amortization schedule. We're going to say this is the amount representing interest at 10%. So here we said these are our commitments for lease payments from 2022 forward, and this is the interest component of those payments. So now we're taking off the interest component. And so now we're going to say balance of the obligation. And it's going to be this amount less the interest is going to give us our net payment balance of the obligation. And if we look, 45,119 gives us exactly our balance right here, 45,119 at the end of the period. So remember, this is disclosure for the year ending 2021. These are our future commitments. And now we've reconciled back to the carrying value of our lease liability on our balance sheet under ASPE. And so that is what our note disclosure would look like.